Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. And today I'm going to talk about how to build a tough portfolio for a tough market. Because if you think about it, the stock market has actually been pretty rocky the last 7 or 8 weeks. And there's a good reason for that. There's actually several reasons. One is that the market had a very difficult first quarter, as we all know. It essentially imploded. It was the fastest bear market in history. And then from the March 23rd lows, the market shot up more than 60%, which was the fastest bull market in history. And anytime you see a big move like that, it takes time to consolidate some of those gains, weed out the investors that really don't want to stick around. And so then you see a bit of a sell-off. But there's been a few changes with the fundamental backdrop as well. The biggest being the spike in coronavirus cases. Now, this was to some extent inevitable because once you reopen the economy and people start mingling and getting out and spending time together, you're going to see confirmed cases rise. But at the same time, we had a couple other negative events. One was that the federal stimulus package looked like a done deal in August. It ended up not happening. It looked like the vaccine would be here by October, but October's behind us now. We didn't get a vaccine. It's still several weeks away. They had to shut down a couple of the trials to assess the illness of some of the trial participants. And then, of course, all the uncertainty surrounding the election and the policies that would be put in place and how would they affect the economy and so on. So, the market is always uncertain because the future is uncertain. No one knows how the economy is going to perform or what interest rates are going to be or what inflation will be or the dollar or commodity prices or what have you. And that means you need to build a tough portfolio for tough markets. Now, how do you do that? Well, the first thing you need to do is make sure that you have a proper asset allocation. That doesn't just mean diversification. If you buy the S&P 500, you're broadly diversified, but you're not very well asset allocated unless you want to be 100% in U.S. large cap stocks. And an asset allocation is how you divide your money up among different non-correlated asset classes. Non-correlated meaning they don't all move in the same direction at the same time. So you would have money in stocks, but you would also have money in bonds, and not just high grade bonds, but also high yield bonds. And not just those two types of bonds, but even inflation adjusted treasuries, which move independently of those other two bond classes. And then among stocks, you want to have growth and value, large cap and small cap, foreign and domestic. And by blending all these different uncorrelated asset classes together, you get a portfolio that gives you good returns, but with less volatility. And that's really the holy grail that investors are looking for: better returns with less risk. So you want to asset allocate your portfolio. You do want to diversify within those asset classes. You want to stick to quality and only buy companies that have real sales and earnings and growth prospects. You want to run what we call a trailing stop behind each of your positions. That means as long as the stock is trending up, you're content to remain a shareholder. But when it plateaus and starts to come down, you're out. And the way you do that is you put a sell stop in, say 25% below the stock when you buy it. And then as it moves up, you raise that trailing stop. And at some point, all stocks are going to peak and start to come down. And then you've locked in your profits instead of letting them slip through your fingers. Or conversely, if you have a loss, you never let a small loss turn into an unacceptable loss. So that's how you go about building a tough portfolio for tough times. If you'd like to read more of my views, I have a complimentary e-letter called Liberty Through Wealth that I contribute to every week. And if you'd like to sign up, it's completely free. Just click on the link below. And I look forward to speaking to you again soon.